Welcome to Investments. I'm Professor Enshan Yang. Today we'll discuss Chapter 19, Financial Statement Analysis. We'll focus on Section 19.1 on major financial statements, Section 19.2 on measuring firm performance, and Section 19.3 on profitability measures. We will need to prepare a calculator, pen or pencil, and pieces of paper or notebook for class. We will also do some in-class exercises and concept check for practice. At the end of our session, we will do summary for review. Before we begin, you might be interested in asking yourself a few questions. First, what are major financial statements? Second, how do we measure firm performance? Third, what are the various measurements for profitability? If you're interested in investing on a specific company, how about let's start with the basics of financial statement. First of all, what are the major financial statements? In order to understand the operations and business activities of a firm, we often focus on the financial statements. And the major financial statements generally include income statement, balance sheet, and statement of cash flow. In an income statement, we focus on revenue, expenses, earnings before interest and income taxes, we call that EBIT for short, and net income. In a balance sheet, we focus on assets, liabilities, and shareholders' equity. In a cash flow statement, we focus on the cash activities of a firm, including cash flow from operation, cash flow from investments, cash provided by financing activities, and net increase in cash. The financial statements not only indicate the cash position of the firm, but also the operation details and asset liability evaluation of the firm. Often at times, we will also find conglomerates with many different subsidiaries, which will produce various versions of financial statements. We have then consolidated financial statements and unconsolidated financial statements. The financial statements for listed companies are required to publish on a periodical basis, say on a quarterly basis with quarterly earnings projections and estimations. At year-end, companies are also required to produce annual financial statements. In order to develop investment strategy, we often look at financial statements for a period of 3 to 5 years for historical firm performance and future firm performance estimation. In the US, company financial statements are available at the Securities Exchange Commission through the EDGAR system, and we call that Electronic Data Gathering, Analysis, and Retrieval System for free access and download. Just type www.edgar.sec. In Taiwan, company financial statements are available at Securities Exchange Commission also through the Market Observation Post System. Financial statements for listed companies are free and for open access for the public. Second, how do we measure firm performance? Generally speaking, investors often measure firm performance in terms of investment decision for company use of capital and financial decision for company source of capital. Therefore, for investment decision making, we often measure firm performance in terms of profit in real assets, including return on assets, return on equity, return on capital, and economic value added. We also measure firm performance in terms of asset efficiency, such as turnover ratios. We further measure firm performance in terms of profitability of sales, such as profit margin calculations. For financing decisions, we measure firm performance in terms of leverage for debt and coverage, as well as liquidity for current ratio, quick ratio, cash ratio, and net working capital. Third, what are the various measurements for profitability? A few of the most important measurements for profitability include return on asset, ROA, return on capital, ROC, and return on equity, ROE. The ROA indicates the income earned over company assets. The ROA value, the higher the better. The ROC indicates the income earned over long-term capital. The ROC value is also the higher the better. The ROE indicates the net income over shareholders' equity. The ROE value as well, the higher the better. We also compare the financial leverage of a firm with ROE during various economic conditions for bad year, normal year, and good year. The financial leverage deals with a company's debt and equity allocation, as well as the interest rate on the debt. Additionally, we have EVA, economic value added calculation, or the so-called residual income. The EVA indicates the opportunity cost for firms to engage in investment projects versus just simply increase stock prices with funds. Therefore, the EVA measures the difference between ROC and cost of capital. Okay. Now, let's take a look at slide 17-1.